Hello and welcome, everyone. If you've clicked on this video, you're likely one of the millions of Americans trying to juggle the weight of student loans during unpredictable financial times. As of 2023, over 43 million borrowers hold a staggering $1.6 trillion in student loan debt in the United States alone. An overwhelming number, isn't it? With the global economic upheaval brought by recent events, many are seeking respite through student loan forbearance, a temporary halt on repayments to help manage financial uncertainty. It sounds like a relief, right? But is it always the best choice? Today, I am diving deep into the pros and cons of entering into forbearance. I'll talk about what forbearance really means, who qualifies, and crucially, how it impacts your financial future. Stay tuned as I unpack all you need to know to make an informed choice about your student loan strategy. What is student loan forbearance? Imagine you're playing a video game and you hit the pause button because you need a break. Student loan forbearance is kind of like that. It's when your lender says, "It's cool, you can take a little break from paying your student loans." This can be super helpful if you're having a tough time with money. But here's the thing. While you're on this break, your loan isn't getting smaller. In fact, the interest keeps growing, like a snowball rolling down a hill. And when you start paying again, that snowball has gotten bigger because the interest got added to what you owe. How it works. For federal student loans, forbearance can typically be granted for up to 12 months at a time. If you still need financial assistance after that period, you can apply for an extension. The total time you can spend under forbearance varies depending on the loan type, but for many federal loans, the cumulative limit can extend up to 3 years. The process usually involves filling out a request form and providing documentation that supports your need for forbearance due to financial hardship or other qualifying reasons. For private student loans, forbearance options vary significantly between lenders and are not as standardized. Private lenders offer forbearance at their discretion and set their own eligibility criteria and limits. Some might allow only a few months while others might grant a longer period, but usually less generously than federal loan programs. Types of forbearance loan: general forbearance, discretionary forbearance. General forbearance, sometimes referred to as discretionary forbearance, is an option where the loan servicer has the discretion to grant forbearance based on the borrower's financial hardship, medical expenses, employment changes, or other qualifying reasons. Eligibility: borrowers with federal direct loans, FFEL program loans, and Perkins loans may apply. Duration: typically granted for up to 12 months at a time. Borrowers may request an extension, but total forbearance shouldn't exceed 3 years. Interest impact: interest continues to accrue on both subsidized and unsubsidized portions of the loan during the forbearance period. Accumulated interest might be capitalized, increasing the overall loan balance after the forbearance period ends. Mandatory forbearance: mandatory forbearance must be granted by the loan servicer if the borrower meets specific eligibility criteria established by federal regulations. Eligibility: conditions include serving in a medical or dental internship/residency, participation in a national service position, qualifications under teacher loan forgiveness, employment in a position that could qualify for partial repayment under certain programs, or if the monthly payment amount of all the borrower's loans exceeds 20% of their gross monthly income. Duration: granted for no more than 12 months at a time, with the possibility of renewal if the borrower continues to meet the eligibility requirements. Interest impact: similar to general forbearance, interest continues to accumulate and may be capitalized. Private student loan forbearance: forbearance terms for private student loans vary significantly by lender and are not standardized like federal student loan forbearance. This type of forbearance is offered at the lender's discretion. Eligibility: determined by the private lender based on their criteria, which can include financial hardship or other conditions similar to those required for federal loan forbearance. Duration: often less generous than federal forbearance options, with some lenders offering forbearance for terms as short as 3 months up to 1 year. Interest impact: interest typically accrues during the forbearance period and is often capitalized at the end, increasing the total cost of the loan. Impact of student loan forbearance on financial future. Impact on loan balance: during forbearance, interest continues to accrue on student loans. For unsubsidized loans and private loans, this interest can add significantly to the total loan balance if not paid during the forbearance period. Once forbearance ends, the accrued interest may capitalize, meaning it is added to the principal balance of the loan. This increases the total amount due and may result in higher future monthly payments. Impact on repayment timeline. Forbearance extends the period it takes to pay off the loan, potentially delaying other financial goals like saving for a home, investing, or planning for retirement. The longer repayment timeline and the capitalization of interest increase the total cost of borrowing, affecting how much money is ultimately paid back. Impact on credit score. While forbearance itself does not negatively impact a credit score directly, as it is reported as an agreed change in loan terms, increased loan balances and potential future defaults, if the larger debt becomes unmanageable, could lead to negative credit events. Psychological and financial planning impacts. Carrying a larger student loan balance for a longer period can cause psychological stress and may delay the achievement of other financial milestones. Reduce flexibility in financial planning. Increased debt load limits financial flexibility. Larger or prolonged debt obligations might restrict the ability to qualify for other loans, such as mortgages or car loans. Pros of student loan forbearance. Temporary financial relief. Forbearance provides immediate relief from payments for borrowers facing short-term financial difficulties, such as loss of employment or unexpected expenses. Prevents default. By pausing payments legally, forbearance helps avoid the severe consequences of loan default, which can severely damage a borrower's credit score and lead to other legal issues. Flexibility in financial planning. It allows borrowers to reallocate funds to more pressing financial obligations like medical bills, rent, or emergency savings during the forbearance period. Simplicity in application. For general forbearance, the application process is usually straightforward, requiring minimal documentation, and decisions are often at the discretion of the service provider. Cons of student loan forbearance. Accrual of interest. Interest continues to accrue on all types of loans during forbearance, which means the total debt grows, and borrowers end up paying more over the life of the loan. Capitalization of interest. Once the forbearance period ends, any unpaid interest can be capitalized, meaning it is added to the principal balance. This increases the total amount of interest that must be paid over the loan's term due to the higher principal. Extended repayment period. Extending the time to repay student loans delays when a borrower can focus financially on other goals like retirement savings, buying a house, or investing. Potential for misuse. Some borrowers might opt for forbearance as a first choice rather than exploring other more advantageous options such as income-driven repayment plans, which could contribute to a healthier long-term financial strategy. Lack of progress towards forgiveness. For borrowers aiming for public service loan forgiveness or other types of forgiveness, entering forbearance does not count as progress toward the required payments needed to qualify for these programs. If you're struggling with student loan payments, forbearance is just one of many relief options that are available to you. But while forbearance can offer temporary relief, it's important to also consider the potential problems it can create for your situation.